Hello, everyone, and welcome to the Professionals Pulse. I'm Farida Musaddi, the co founder and CEO of Al Fateh Technologies Dubai. Headquartered here in Dubai, we are technology consultants offering a wide portfolio of IT services under the realm of automation, custom software development, data analytics, cybersecurity, AI, IoT, network infrastructure, process outsourcing, and much more. Currently, we are also in discussions with government bodies around the world for digital transformation and smart city projects. And today, we are going to talk about something which I'm sure many of you are struggling with, many of you are contemplating. Well, yes, today we're talking about the critical choice every entrepreneur faces: bootstrapping versus fundraising. Let's explore the advantages and the challenges of each of these approaches, whether you're considering leveraging your own resources to maintain the control and also to maximize profits, or you're seeking external funding to accelerate the growth and scale quickly. This episode provides valuable insights and real world experiences to help you make informed decisions. Join us as we discuss strategies, share success stories, and offer some practical advice on navigating the financial landscape of building and expanding your business. And joining us today on stage is Miss Ina.
Hello.
Hello, how are you?
I'm very excited. So excited that I almost stopped you there.
So, Miss Ina Femi is the co founder of and CEO of FEMSO. She brings a wealth of experience to our discussions on bootstrapping versus fundraising today. Since moving from Albania to New Zealand in 2018, she has embarked on her seventh business venture with FEMSO, which has had the most profound impact on her life. With over 15 years of experience managing multiple companies and serving as the head of product development at FAMSO, Ina has a deep understanding of the critical role of cash flow in startup ventures. Her journey is especially insightful as FEMSO's growth has been driven by the power of bootstrapping. Over the past 2 years, Ina and her team have utilized their own resources and the determination to launch FEMSO, a cutting edge SaaS platform that revolutionizes how we experience and consume fashion. Their organic approach has enabled them to build a very strong foundation, expand their user base, and increase the company's valuation, setting the stage for their first fundraising round. Get ready to hear Ina's valuable insights and experiences in building and launching her own tech platform. So, once again, Ina, welcome to the Professionals Pulse. It's great to have you here with us.
It's a pleasure, Farida. It's very exciting to be here and to talk about bootstrapping versus fundraising. Is one of those themes that is not ever talked enough because everyone should talk about it. Information sometimes is the queen that makes the right movement towards
Absolutely.
cash flow, and cash is king, but you need that kind of information to make smart and educated decisions. So happy to be part of this conversation in this podcast.
The pleasure is all ours. So, before we start with diving into the topic of bootstrapping versus fundraising, I want to know something about your brand, FEMSO. Can you just tell us about what it is? What does it do?
Absolutely. So FameSaw came as a solution from our pain points in our vision boards. before COVID hit, because when COVID hit, I had two previous businesses and they were in the fashion industry. One of them was the rental company. When people could rent their own wardrobe, it started as a fun side hustle between me and my co-founder. We had too many clothes in our wardrobe, and we were like, why don't we make some money out of it? And it started like that. But then COVID happened. We had another business on luxury goods, importing those from Europe and selling them in the New Zealand market and also Australian market. Made some really good money. COVID happened, and from one day, people from dressing up, they went in PJs. Everything kind of
Yeah.
changed. We were left with a lot of stock, with a lot of debt at the time. And yeah, we didn't have any kind of idea how long COVID would last, what will happen. What the best thing that happened, and I liked it a lot, it is that the human behavior shifted completely. So it was the perfect time to pivot the businesses, and that's what FAMESA, how FAMESA was created. Um, I do remember it was a Tony Robbins seminar when I was like, how can I have a business that solves a lot of problems, that doesn't create a lot of problems for me as well as a founder, like no stock, no liabilities. I wanted the dream.
Okay.
And I called my co-founder at that time and I said, forget the retail, we're going into tech. And we had no idea what tech was. Like really. And she was like, are you sure? And I was like, full on sure. We're going into tech because that's where the human behavior is going. If we want to provide a product that brings value, impacts lives, empower people, that's where we're going. It's not about only anymore wearing something. It's about the lifestyle and what fashion impacts in your everyday life. So it started with that kind of idea. And what happened it is that 2 years, almost 3 years later, now we have launched our platform in New
Okay.
Zealand. It's a fashion ecosystem which allows people to monetize not only their accessories but also their time and skills. What has happened it is that the fashion industry is one of those industries that is a bit rusted, a bit old school, while all of the other industries have moved forward and innovation has kicked in and taken control. Fashion is still controlled by these big houses and they control the human behaviors. And it is a bit of a shame because these big houses are controlled by, let's say, most of them by men, when in fashion, most of the consumers are women. Doesn't make that much of a sense. So we wanted to bring a bit of fairness, and instead of being in the end of taking fashion and behaving only as consumers. We were like, let's do what Airbnb did with the apartments and with houses. Let's do what Uber did with the taxis and the cars. Let's do what Google did with the information. Let's give and wake up to the people the knowledge that they have fashion in their day. As long as you wear something, you don't go out naked. You're consuming fashion. It's not just
Absolutely.
trends. Therefore, you can make money out of it. And it's not just by reselling their e-commerce, but it is by creating so many other jobs that the fashion industry right now controls, like being a personal stylist, being an influencer, a creator, being a cleanup wardrobe, being the fashion students. They can have a place where they can showcase their
Showcase.
designs, but
Right.
also meant kind of things, and also educational. So we kind of started from these kind of things. We kind of took all the elements of the fashion industry, put them in one platform, very intuitive how to navigate through that, and we're giving it to people here. Make money, have fun, collaborate by making fashion accessible, more inclusive, more diverse, and also more m- more visible and approachable to people, so people can have a say and a power into it. So that's what FameSo is.
Wow. I think that's a really wonderful idea, to combine fashion and technology together and to give so many varied aspects to it, right? From education to a student point of view to something which is, I mean, if I have something and I just want to monetize it. So, so many varied dimensions. Absolutely, really interesting thought.
I appreciate it. It came from a lot of points that I had myself as a woman, and I've done a lot of studies to look at how other people behave and what they want. So it came as an answer of those many problems that exist in the fashion industry.
Congratulations for that,
Thank
and
you.
we wish you all the very best. Um, so, to begin with, what are the key advantages and disadvantages of bootstrapping versus fundraising when it comes to scaling a business?
Well, let's start first of all with bootstrapping. Like everything else, it has like the coin has two faces. Bootstrapping has some good parts and some bad parts. First of all, it is very cheap, which means that it is, let's say that normally it has a low cost of entry market compared to fundraising, and that's one of the best thing ever when it comes to bootstrapping, because you can start even with $100, with $1,000, and
Absolutely.
you can grow during the time. In the same time, it has a very high ticket expense in your personal stress and your mental health. You really have to prepare for it, because it's not something for the weak minded. It affects your life a lot, because you put not only your life savings but your time, that your time you have only 24 hours, you put it in your business, in your family. You have to have a relationship, so you have to really calculate very well how the time has to be invested into your startup. Another good thing about bootstrapping is that by relying on your own saving and also having sometimes the revenue growth that comes from your business, that helps you kind of have full control of the company. There is no boards. You call all of the shots. There is no one that will tell you what to do about your business. King of the castle, which is amazing. That
Yes.
happens normally when there is only one person, but
Mhm.
when there are more than two fundraisers, the ugly part of that it is that sometimes what happens, and a lot of founders wake up a day without realizing that when there are many founders, has sometimes happens a disbalance and a disharmony based on the balance of each founder's investment on time, skills, and resources, and that can create a bitter kind of atmosphere in the company. It is very well known in so many companies. Remember what happened with Facebook and all the founders, only one survived. So this comes from the investment of these founders during the bootstrapping period of time. But on the bright side, what happens during the bootstrap period, it is that it allows you to be very focused on the business, on the development of the main product, and that's amazing because you don't have other people to tell you what to do. And the business model, it is very clean and very simple.
Correct.
The other side that comes on this thing is that you, although you have the freedom and the flexibility to grow, you don't have the
Correct.
unlimited cash flow to
Resources.
grow fast. And that kind of, it is not that good, because depends where the vision of the company is. You have to calculate your goals, the breakdown of the metrics and KPIs that you have to achieve, and without money that will take you a lot of time, and you will
Yes.
understand that through the system, and through this process you will need experience and expertise to be on top of the market. So these are some of the good things and bad things about bootstrapping. Fundraising is pretty easy. Fundraising normally has three amazing outcomes. The first one, of course, it is cash flow, and cash flow allows you to immediately grow,
Scale up.
immediately to be in the map in the market, and it gives you also the freedom to adapt and to innovate faster. The second outcome that I really like more than anything else, it is the resources, the network connections. The money allows you to buy expertise, the right talent, and at one point you'll understand in your business that there's nothing more powerful to have the right network around you and the right talent that is like operating and executing on your idea. And the
Correct.
third thing that a VC or a fundraising can give to you, it is the validation. Like when you are for the first time founder that you're creating a business, you have to be the jack of all trades. You wear so many hats and you really don't have a name out there. You have to prove first for the people to come after. But
Correct.
once you raise only once capital, then people don't ask anymore, who are you? They go, okay, how much this time? What's the plan? What's the cap table? What's the exit point? So the questions change. And that
Absolutely.
comes with capital and fundraising. So those are the advantage, the biggest advantages that comes from fundraising. Then you have the ugly side, which means losing control. That's normally what happens. You get diluted,
Pressure.
and yeah, it happens. You will have an advisory board. The pressure stake is higher. You have to answer. You will be married with this kind of people that from stranger becomes the ones that you have to report. But
What?
that's somehow in every kind of business. So you
Absolutely.
have to accept it and to roll with it.
But just from your personal experience, how easy is it for a startup to raise funds?
Very difficult and not easy at all. It's absolutely hard. And the way that people kind of romanticize about it and how it is shown, especially in the media, in YouTube's like, oh my God, it they sell on the emotions. You look at Shark Tank, for example, and this is amazing emotion when they say yes, finally there's a lot of hugging, and when you look and check on lots of those kind of businesses, 90% of them has failed. It's not that easy to raise money. A lot of factors have to apply. I'll share you a personal experience. Uh, During the bootstrapping, I said to my company, we are like, have you ever seen those movies like the rural football team has the aim to kind of win the championship? That's bootstrapping, where the captain has to deal with all the team players, have to kind of invest in their skill set, have to leave someone out, headhunt for other kind of talents till you make it to the championship. And
Absolutely.
that is bootstrapping. It's not easy, it's hard
It's
work,
a long
but
journey.
it is amazing if when it happens to reach to that kind of milestone. But after that, what happens in during the way, you will have media, you will have, you like, more successful you become, you will have more kind of people that will be interested in you, and this is the investors that will look for you. You will have the people that like the talent that want to work for you, and this is where the fundraising happens. I look at fundraising as a courting. It's like you opening a Tinder profile or a Bumble profile or something. Like it's really like that. You open it, and the equivalent of that is LinkedIn for businesses. And by the way, I'm so bad at it. Everyone that is looking at this, invest on your LinkedIn, because everybody will look at your LinkedIn. Don't take my example. I've learned that lesson very, very late. But what happens it is that in the beginning, you normally do a match based on likability, and then you start this kind of courtship, which is based on trust. When you start to introduce yourself to the investor, you pitch to them. Doesn't matter how amazing is the story, they are going to invest on you as a person, because you are going to make and execute the idea. So this is where the hard part comes, because that courting, that dance now becomes like a marriage certificate that you have to. It's like dating when you are 40, 30 to 40, when you don't go anymore into passion, but you go like financials, how are there, what is your business model, what you have done for this kind to minimize this kind of risk. You go through a lot of due diligence before you go even to the term sheet. And that is
Correct.
not easy, because most of the founders don't even understand that, even though they probably are doing something like that in other areas of their life. But they get scared like a deer in front of headlights. They get scared because information and experience, it is lacking most of the times.
Yeah.
So that makes it difficult, and there are hundreds of founders that are looking for capital. It's not easy. You'll get
Absolutely.
probably 100 no's and only one or six yeses, those are the ones that matter. What matter the most during this process, it is that prepare for the no's, and when you get a no, that doesn't mean a no. That means that the person had a bad day at the time. Their portfolio doesn't fit with your portfolio. Means that you have to improve yourself. And instead of taking the rejection, maybe do constructive questions and ask, why am I not a fit for you? Or what do I think? What do you think that what would make you
What
say
was missing?
yes? So
Yes.
things that you can learn and improve your pitch, and the most important, understand where to go to ask for money, because a lot of founders, they don't understand the concept of the founder personas, the same way that we do market research and create our user personas. When you raise capital, you have to think, who is, how does your perfect investor look like, what you're looking for, what's their culture. You're going to be with this person for a long time. They are going to invest money. You're going to be responsible for those
For
money,
them.
and
Absolutely.
you have to return the you have promised to them the return of the investment. So of course you are going to do do due diligence on them the same way that they are going to do on you. So all of that process, that is not easy. It takes time, and it takes a lot of mental strength for you to, as a founder, to go through all of the stages successfully. And that's one thing that the founder should understand. A lot of people talk there about raising capital, not many people make it.
Yes. And as you very correctly says, what is shown on media is, the emotional story, the emotions behind it. So everybody aspires and feels that, okay, you just have to come up with a very interesting idea and a very interesting story, and you might be able to impress. But there's actually a lot of effort that goes in your vision, your goal. I think everything
Absolutely.
counts before you even reach to the investor. So that
Absolutely.
journey is really hard. um,
Yes.
so I this what you answered was my other question itself, that an example of how businesses have thrived through the approach, and what aspiring entrepreneurs, which you answered so wonderfully, that the journey is not difficult, but at the same time you don't have to be dejected by the no's. Rather than use that as a constructive feedback to improve on what is missing, so that you can again pitch in a more better way. So I think that's a wonderful thought for everybody out there, and the way you related it to the entire courtship example, I think that's wonderful.
Well, I'm happy that you like it. I have to come with an explanation that 5 years old people understand, because when I explain it to my team, they get it. Don't get me wrong, they get it. But unless the information ticks something in their brain, they will forget it after 5 days. So I have to go over and over and repeat and find examples that they can relate.
And in the leadership role, you have to be constantly, motivating the team. Sometimes as a leader, if you feel dejected, or if you feel a little bit of negativity coming in, the team will automatically feel that. So it has to be a wholesome approach, where as a founder you have to be motivated, and at this end you have to make that vision, whatever goal, whatever vision you have in mind, the same goal and the same vision should be there with the team as well.
When you start a company, it is said over and over everywhere, and it is a absolutely gold rule that you have to have your why, you have to have your vision, you have to have your mission, and the most important part, you have to have your culture that is embodied in everything that you do. In the team, it is part of that culture. As a leader, as a founder, it is very important for us to be understanding, empathetic, and also go into workshops not only in product development but also in emotional intelligence and mental development on how can we go from this stage that we are in the next stage, because out of 30 days that a month normally has, only 5 days will be yay. The other ones will be like, oh shit, what do we do with this, and how can we sort out this problem? It's not
Correct.
an easy road, and any founder has to have a connection, especially with the core team, because those are that they will make it or they will break it. The idea, it is important, not as important as who is going to make the idea happen and how that is going to be executed.
Correct. I think I absolutely agree with this. So, how does the decision between bootstrapping and fundraising impact a company's long-term growth trajectory and the overall sustainability? Like, at which point can a company think from being bootstrapped to going for fundraising?
Mhm. Well, let's say that when it comes to long term growth trajectory and overall sustainability, there is all the time the idea to go between bootstrapping or fundraising has huge impact on the
Correct.
growth of the company. You normally, most of the founders, 99% of them start with bootstrapping, which is very good because that means that the founders themselves and the core team will have a self-awareness not only of their own skills but also of the company. So they will know the weaknesses, they will know the strength of the company, and they will grow because they are going to live it and breathing every day. This, in other words, it is
Correct.
creates really strong foundation, creates organic growth, which makes it for long term more sustainable as a business. But if you want to go fast and to grow beyond the market that you already have conquered or beyond the MVP, a prototype that you have created, sometimes, especially in tech companies, you will need funding. Innovation is tech, and tech is not cheap. You need capital, especially at this time. There are some examples and all story, and I hear this all the time. It doesn't make sense to me. There are amazing examples out there for people that have done bootstrapping. You have MailChimp, you have Dell, you have Microsoft, you have Meta, Facebook at the time. You have so many companies that they are used still as an example. Even though you can get inspired from those stories, the rules have changed. People are so oversaturated right now, so the same rules don't apply anymore. So when you kind of have bootstrapped it for 2 to 3 years, that showcases more the skill set of your team, the resilience of your team, the execution of your team, and the vision of the company more than the idea yourself. Because somebody in China will get your idea, will make it happen for, let's say, 1 month because they have unlimited access on the money. So when it comes to innovation, you don't only have to have very strong foundation to predict future growth, but in the same time, you have to be uh, on top of the market, in top of the innovation. You have to predict everything that is moving. You have to look at the human behavior. You have to understand the customer needs, and
It's
for
an
this to
ongoing
make it
thing.
happen, you need capital, because capital money saves time. Money in businesses saves years, and that's what you need. It's like look working in the future. You have to have capital at one point if you want to go be a multi-million dollar company. And this is, for example, they invest and they look for multi-billion dollars company. They don't even take in consideration if a business doesn't have the potential to be a multi-billion dollar company. It's a fact,
Correct.
because and that's not bad because that's their portfolio. VCs are not the evil, but as a founders we have to look, how long do we bootstrap, where is the goal, what have we to do to reach that milestone, which where is the turning point, and how much runaway capital cash flow do we need to go to that point, and from that point where do we find the capital, and what kind of founders are we looking for, and can be
Correct.
VCs, can be indie founding, can be some other kind of funding, can be crowdfunding, can be debt funding. There right now the founding scene is much more founder friendly than it was before, so we're quite
Okay.
blessed as long as we understand the company needs, because that making a fund, raising capital is not easy, and it's one of those kind of decisions that will change forever your company. Once it is done, you can't take it back. Therefore, it is so important to make the breakdown of your company before being the airplane. You're the bicycle. What do you do to do next? And who is going to do it? How much money you need for it? What are the goals? Will the consumer still love this product after this time? And once you have answered all of those questions, the founders or the board will make the decision. Okay, this is the time when you raise capital, or we're still going to bootstrap it for a little longer till the valuation of the company reaches this point. So the price share and the valuation will go higher.
Higher.
Those are
Correct.
strategic kind of thinking that are personal for every founder, that they have to make the call themselves based on the company
Absolutely.
needs.
Yeah, and I think that's a very valid point, to be able to know that what step the company is right now, what would be the market share of the company, and accordingly make an informed decision whether this is the right time to go in for fundraising, or proceed with bootstrapping for a little longer time. So absolutely agree with that point.
I remember I was offered, we were just in the first year, I was offered a lot of money just for some shares of the company. Um,
Okay.
we forget, sometimes we don't mention that whatever, when you are in a startup, whatever, when we raise capital, that will be the most expensive sell that we'll make in our life, because our shares will not be that price ever if we aim to be successful. Therefore, we were in the beginning, we were like, let's get the money, put them in the company so we can pump in innovation and in product development, and also market research and customer acquisition and everything that makes the company to generate that revenue. But
Correct.
we had to say no. We had to say no because sometimes the company can, if you can bootstrap for a little longer on your own, you give the value to the company, but also to the next, that, let's say, investors, that when they see that the founders really have managed to create something amazing during bootstrapping, you
Yes.
minimize, yeah, you minimize the risk for them, and you tell to them, yeah, these people can do the and can execute the vision. So we had to hold for another
Correct.
years, and we're raising capital now.
Wow, that's wonderful. Really amazing to hear this. And as it's coming from someone who's experienced this, I think it's you're able to better explain the journey, because you've been through that, you've done that. So the I think anybody can relate to this more than someone who is just saying things but has not experienced that kind of journey. So I think that makes it all the more relatable.
Well, thank you. I'm trying to explain on with certain ways that everybody that has been at least one time a founder, they can absolutely understand the pain, the joy, the thrill of fundraising and also bootstrapping.
So, in a, are there certain industries or type of businesses that are better suited for bootstrapping, and while others may benefit more from fundraising?
Um, More than the business model, this I would relate from my experience. I would relate it this one to the vision of the company, the exit points, and also of the founder's lifestyle. When
Okay,
you are as a founder, you have a certain lifestyle, and that will mirror into your business. Depends what do you want from your life, and that directly, you like it or not, will mirror on into your impact on the company, because the cap table will be affected by the exit of the main founders. Normally, everybody that invests, they want the founders to stay as long as possible in the business when they
absolutely
are especially crucial for the business. Said that, the founder from the other side have to understand not only their exit but everybody exits, especially of the core team. I've gone that far to understand the relationship that my team, a core team, has with their own partners, because sometimes even things like that can affect the the growth of the company. And you don't want to wake up a moment a day and go like some investors or some shareholders or somebody from the core team that has shares is having a problem, and that will be immediately reflected on your company. So when it comes to bootstrapping and also fundraising, pretty much comes to two factors: what's your lifestyle, what's the thing and dream life that you want to have, what's your vision in 5-10 years, and what you're going to do with it. VCs are not going to invest in any kind of things unless you have at least 5 to 10 years run. They want that after 10 years, they will at least have 3x times the value of the shares that they are investing. If it is a person,
That's
if it is a person like an angel investors or a small investment firm, you still owe to them for the investment that they have done on you to return the capital on that investments, because they have been there in the days that you wanted to grow. So that one, those kind of things
that's
makes
your
the exit.
responsibility towards them.
Absolutely. And from the responsibility becomes the company's responsibility, because once fundraising comes to the company, you can't control anymore the company the same way that you were before on into bootstrapping. Into bootstrapping, you can take cash out of the company based on your personal needs and the company needs. But once founders, other investor comes um, in the company, you they don't like dividends, for the founders to withdraw dividends, especially in the first years. There are certain kind of rules that you just have to play by those rules. So it is very important to understand that the exit point as a founder and their lifestyle, and their mindset, the general mindset makes it a break point for the investor to come and jump in this kind of investment or not.
Okay. So it doesn't matter which industry, but of course, your
Doesn't.
lifestyle, your mindset, your vision, that's what decides whether you want to go in for a bootstrap, want to go
Let's
in for
put it like
bootstrap.
this. Let's put it like this. If I am creating, for example, a fashion brand, or if I'm creating a product, vegetarian meat, for example, but I want only to be into a certain small market, I can bootstrap it for a long time because my
Absolutely.
lifestyle mirrors the vision of my company. But if I'm creating a SaaS tech platform, or if I'm creating these amazing drinks, but I think that these drinks will be so amazing that has to be everywhere in the world, I will need capital for that. Therefore, whoever is going to bring capital, they are going to pay attention. What is Ina doing? How Ina spends her time? How many hours she's going to spend in the business? How much money she is going to withdraw from the business? What are the terms? So it depends more into the exit points and also into the lifestyle of the core team, because the vision has to adapt to who makes the vision happen.
Correct, correct. And that's a beautifully said example, that of course the lifestyle does matter. As an investor, they would want to see a wholesome view, not only of what your business is, but as you said even earlier, they are investing on you as a person, and you have to give them that trust that you would be responsible with the money that they provide you with.
Trust and integrity has to be from day one, and it has to continue like that for the rest of your lifeline, not only during the business time but even beyond that, because founders, they like it or not, they are related with the brand of the company that they create. It's kind of a
Correct.
currency.
So, what are the some of the common misconceptions, about bootstrapping and fundraising, and how can entrepreneurs navigate these misconceptions when making strategic decisions for their business?
I love this question because I've done all of the mistakes in this one. Uh, one of the misconception it is that capital bringing capital in the company means that you will be diluted and lose control of the company. That doesn't happen. First of all,
Hmm.
it's
And that's
so
a very
hard.
common thing which people feel.
Yeah, they think, but doesn't have to happen, because once you educate yourself in certain ways, you will know that you can navigate the term and the conditions of agreements. And sometimes even the investors, they don't want that the founders lose control. But founders get so scared about this kind of misconception that it is out there. It's like it's, I don't know why, but for so many years the VCs or the investments is look like the evil that will take over your business. Not at all. It depends who you're bringing in the company. Once you know that they are the right people, actually they are there to elevate your business, because they want your success even more than you, because they have put money into that. And most of
Absolutely.
them, they don't even want to do the work, because they already have somebody else there that they are doing the work, or they are giving you money to go and hire the best talent that is out there, because the business, more it grows, more experience bringers you will need to put into the business weak points. So that's one of the misconception. The other one, it is the dilution. This was so hard for me, because when you are a founder, in my company we're three, so normally bringing another one means that we go like, okay, we were pre-seed, now we're seed, we will go soon series A. By series B, will we have anything left in our kind of shares? That's kind of the normal scare that you get, especially in the beginning of the business. I remember one meeting with a very extremely successful entrepreneur. I was sitting there and I was explaining to him why I was adamant not to give more than 20%. And he goes like, how much is your company valued now? And I was like, well, right now it is not valued much, only $2 million. It was about 3 years ago in the beginning. And he was like, yes, but you still don't have a proven concept, and you still haven't been in the market, and you still haven't done all of the economic units that you need to prove
Correct.
that you have a market fit, you have created a market fit product. So he said, well, without capital, you have 100% of 0% of the zero thing is still 100, like 100% of zero is zero, so you have nothing. And I was like,
Correct.
actually I don't even have money, and I will lose even more money into this one. So when money comes, welcome it, because it allows you to grow. You just be more mindful on how to use that money, and what terms of conditions that you go into this kind of agreements. And
Yeah, that's
everything is,
very important.
it can be negotiated, because if the investor likes you and they know that you understand what you're doing, they will give you the voting rights. There are founders there that they sell the shares, but they buy back the voting rights. And there are
Okay.
so many ways that you can put into a shareholders agreement. Just because it has a legal kind of concept behind it doesn't mean that you can't negotiate in the shareholders agreement. It's two people talking and agreeing to each other, so
Correct.
nobody should be scared of that. Another misconception is that fundraising is the only option
Mm-hmm.
to grow out there. Probably it is if you want to go global and want to be a multi-billion-dollar company, or to grow very fast. But
Yes.
if you're going to penetrate a new market, there are other kind of ways. You can go crowdfunding. You can look for there are grants from the company, from the
Yes.
governments, that
From the government.
allow.
Yes.
Exactly. So a lot of founders, they have to do a lot of due diligence to have access to this kind of money. Raising capital is not easy. Bootstrapping is not easy. But if it was easy, everybody would do it.
So I just wanted to ask, for the interest of people, of the viewers who are listening, what's the difference between crowdfunding and the VC funding?
Okay, so VC funding, normally VCs, they are venture capitalist firms, which is normally what these kind of firms, they collect investors from, like, experienced investors from a region or all over the world, and they have their own portfolio where they invest based on the KPIs that the firm has. So that's why I said before, don't take it personally sometimes that they say no, because depends if they have
That might
already
not
reached
be
their
their.
KPIs. It is the wrong time. You are not in the same align for what they want to invest. And the VCs normally have more money. They
Okay.
go after companies that have a promise to not only grow but have a raise of the share price, consistent raise during the years. So they look at a lot of things. That
Okay.
is the normal way. The crowdfunding, it is a new way, which is a bit more popular for the new businesses startups. Means that if I have, for example, let's say my own product fame, so it's kind of a boutique product, means that it is high tech SaaS, but in the same time, because people can immediately find value into it by downloading an app, means that immediately they can access it and see, and they use it in their everyday life, and
They like.
also validate the product.
Correct.
By having such easy access to the market product that also brings value to the people they are using, instead of going for VCs or other kind of funding, you can go for a crowdfunding where you open the process to the crowdfunding to all of the people that might help you, from $1 to $10,000 tickets. Depends how you build up the process, but there are not VCs that are investing. There are normal people or very, very small investors that they are trying to make an investment. And some people, some companies, normally they give very small percentage shares. That is all kind of shared between all of the, let's say, people that give you a ticket, some money, or benefits that they get by being the first ones to invest in your company. By
Okay.
and that is the best way.
Okay.
It's a good boost to give you some money till you go to the next stage.
Okay. Yeah, I think that's wonderfully explained. So, in our on parting thoughts, what advice would you give to companies, who are starting out there? There are a lot of people who want to start their entrepreneurial journey, but they may have an idea, they may have a very limited access to resources, but they have a big vision, they want to grow big. So what advice would you give to such entrepreneurs?
First of all, educate yourself. Invest on yourself even before investing in your company. When your company will grow, you have to grow even one step higher than your company. You have to be self aware for your own skill set, because that will impact immediately your company. It's just a fact. That self awareness with time has to go from a self awareness of the let's say founder, to the self awareness of the company, and will go from your ego, and your validation has to be put on a bin, literally, and you have to focus what the company needs, and you have to be so resilient, so determined to go and get it and make it happen, and to show up all the time. I've met so many people. There is so much money that is out there, and the people that are having making the money are not sometimes the smartest, or they are not even the one that have the best idea. I've learned it, and maybe I'm wrong, but squeaky wheel gets the oil. It's pretty much whoever shows up, no matter what, every day. When others don't show up, you have to show up, to be all
Correct.
the time on top of your business, all the time on top of yourself. When you don't have money, it's so difficult to start.
Yes.
um, Before you sell the, when I started Fame, so I didn't have much money, probably $10,000. But the idea was so good that it inspired not just me, but I knew that I could sell this idea to the other. But instead of going to the VCs will they will just go like, "You're crazy. Why you're coming at me?"
Yeah.
Normally, you go to people that can help you execute the initial prototype, the initial MVP, minimum viable product.
To believe in
People
yourself
that
and join you.
that not only believe in yourself, but they will give you the tools. So I went
Yes.
out and found the people that will create the first prototype, the first MVP. And this time exchanged like everybody does is in a startup with equity for shares, and make the product come to a point that it is undisputable, required or wanted by not only the market but also by the future trends of the market. Once you reach that, then you go, it will be very easy to go and look for capital. And when you are at that point, then you have to be prepared to fire yourself. Means that if you want to grow really, really fast, you will have to understand that you are not the best in the market. It is so important. You have two choices: to upgrade yourself all the time, all the time, all the time, or to go and hire the best is there, because you have to think for the best of the company needs.
Correct.
And that is an absolute rule. So those are the things that normally I would say for any person that starts. It's not even believing in yourself. More than believing, you have to show up. It's about
Yeah.
finding the right people that will execute the idea. It's
Correct.
hard to make it on your own. The It's so hard to come back and not making money and just
Yeah.
spending more and more money. In the beginning might look fun. After a year, 2 years is exhausting. Therefore, you have to find those people that will make it happen and
You have to
make smart
collaborate.
choices. Yeah,
Correct.
make smart choices to bring value to your product by bringing even more talent, even investing on yourself, and also even looking at all the time looking at market research and everything. So you really don't get left behind just because you have an idea and a vision and you have to do it like that. It doesn't have to be perfect. It has to be relatable. It has to be likable, and it has to be futuristic at this point. So it's not even what's your perfect idea, it is what the consumer needs. And sometimes fame, so for example, started in as one thing, and you then the company kind of orientates where the company goes, not even the founders. The founder head and all the team have to be so flexible and to understand, to be adapt, that
Adaptive. Yes.
you just have to go with it and show up. That's what matters.
So, Ina, once again, thank you so much for all of these insights. The session has been so informative for everyone out there. And
I
I
hope
think
so.
now, yes, absolutely. And as I mentioned before, since you've been through the journey, you've been able to explain it in very valid examples, very valid points. And I know a lot of people have these question marks, and as you said, there are a lot of misconceptions around it. So you have cleared a lot of that. So thank you so much for such an insightful discussion.
Appreciate it. It was absolutely a pleasure. So delighted to be in here, and I really hope that I gave some information for whoever needs this type of information, at especially on a startup process.
Absolutely. So, once again, everyone signing off. Thank you so much for joining us on this episode. We hope that these insights and experience that we have shared today have provided you with valuable guidance as you navigate your entrepreneurial journey. Remember, whether you choose to bootstrap or seek external funding, the key is to align your strategy with your business goals as well as your vision. Stay tuned for more episodes packed with expert advice and inspiring stories. Until next time, keep innovating and pushing the boundaries of what's possible. Thank you.